Hey, what's up, everybody? It is Tuesday, February 6th. So, over the weekend, actually on Sunday, Jerome Powell did an interview with 60 Minutes. I actually alerted my subscribers on Friday. I said, well, he's going to be doing an interview on 60 Minutes on Sunday night, so you better get ready for volatility in the market on Monday. And by volatility, that means market's going to go down. And sure enough, actually Sunday night, I checked Sunday night the futures, and futures were not down that much. But Monday came and they clobbered the market. And I said, what we've seen in the past, almost every single time, was that if you would go against these monetarist zombie reactions, which is exactly what this is, then that pays off. I mean, we saw this recently a couple of times with the Fed meeting and Powell's comments at the press conference, which were construed as hawkish, and they sold the market off and it came right back. And then we saw it again with the strong jobs number. Was last Friday, and then the market popped up, made a new all-time record high. And then we just keep seeing this behavior over and over and over again. You would think they would learn by now, but they just don't. I mean, they just keep doing the same thing. So I've said in the past that it pays to go against misinformation, it pays to go against ignorance, it pays to go against stupidity, and it pays to go against emotional behavior. I mean, one of the foundations of any kind of successful trading or investing, as I say all the time, and I did a video, it's the game is easy. The game is simple, but it's not easy, because the hard part is controlling your own emotions and fighting against that urge to act emotionally. And that's what these people do all the time. I mean, we see it time and time again, repeated behavior over and over and over again, where they just have the wrong understanding of pretty much everything when it comes to how the monetary system operates. And certainly they have the wrong understanding about monetary policy and the effects of monetary policy. I've been highlighting this over at least the last 2 years, if not longer, okay? Starting off with when the Fed was going to raise interest rates, and then over the course of time when they were raising interest rates, and I kept saying that, folks, this is going to be bullish, this is going to be a fiscal transfer, the government is a net payer of interest. When the Fed raises interest, it necessarily equates to a fiscal expansion. You're having interest income transfers into the economy. And that's exactly what has happened, and it has kept economic growth strong. It has kept the market on an upward trajectory. Initially, I said the first reaction was going to be negative when the Fed started to raise rates, but then we would hit an inflection point where that interest income flow would offset any of the discounting due to higher rates. But I'm not going to get into that. But I called the exact date. I said it was October. It was in October 2022. And I said it at the time. Right now, you've got leading fiscal flows that are 115, 116 billion above last year. Last year, the government spent 7 trillion on the top line. And I keep coming back to this number. I keep mentioning this number because this is an extraordinary amount of top line spending. And I gave you some comparison in the last video when I said during George W. Bush's presidency, government was doing something like 2.5 trillion annually. During the Trump presidency, Obama-Trump, leading up until the COVID crisis, it was something like 4.5 trillion, 4.6, 4.7. Then we got into the whole COVID thing, and that shot us up to over 7 trillion. And that's where we are right now. I mean, that is a massive, massive amount of leading spending flow. Now, we're not seeing the deficits that we saw during the COVID period because taxes have gone back up. They haven't been increased by law, but I mean, I explained this in a prior video that when the economy expands, the government necessarily collects more taxes because people are earning more, corporate profits are higher. So it's almost like a reverse automatic stabilizer. And that's one of the reasons why the deficit, which by the way is still on track this year to hit like 1.6 trillion. But we were up near 3 trillion during the peak COVID years in 2021. Okay, it was like 2.9 trillion. And then that dropped in 2022 by 1.7 trillion. I mean, that was an enormous reduction in those net transfers. Anyway, the top line is strong, top line spending is strong, and that's what's keeping the stock market on an upward trajectory. And by the way, I still see a lot of negativity, a lot of pessimism, a lot of bearish sentiment. I mean, when I look at the news, you got all these big shots. By the way, I want to mention too, I was about to say, you got all these still widely followed people, these so-called Wall Street big shots who are still saying recession is coming. Okay, they were all wrong last year. They're saying, okay, now it's going to come this year. Or there's going to be a massive crash. It's going to be the worst thing, blah, 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 like the same stuff we've been hearing forever. But what I wanted to mention, saying that just made me recollect that, remember this guy, Mike Wilson of Morgan Stanley? I think I talked about him several times in videos. He was this super perma bear at Morgan Stanley. When the Fed started raising interest rates, he was predicting this massive crash in the stock market. And it's one thing to predict that crash at the outset based on your mythology or your ignorance or lack of understanding about the effect of monetary policy and specifically rate increases, what I just mentioned, how they add to fiscal flows. But he kept saying that even as the market started to recover and started to go up to new highs, he kept saying that and he kept saying that and he kept saying that. We're going to see a crash. It's going to drop 20-30%. It's just wait. This is a rally in a bear market rally, bull trap, bear trap, whatever they call it. And I was like, when are they gonna call this guy out? I mean, just 2 weeks ago, I don't even know if it was 2 weeks, it might have even been a week ago, he was paraded on CNBC, which is a network that I personally do not watch because it's ridiculous. But a friend of mine sent me the clip from his appearance on Squawk Box, where he was saying, well, now maybe it's okay to be a stock picker. So he goes from this big macro guy who was super bearish to now maybe it's okay to be a stock picker. And I thought, that's ridiculous. Like, you're changing your stripes? I mean, have some consistency, man. Or at least say, hey, you know what? I got the whole thing wrong. There's something I don't understand about this rate hike stuff. That obviously it didn't pan out. No, none of them say anything like that. But anyway, I find out on Friday, it was in the news, at least the financial news, that this guy, Mike Wilson at Morgan Stanley, has been demoted. He was the chairman of their investment policy committee or something like that. It seemed to be the guy who was the head guy in their market outlook, their economic outlook committee. He was the big wig, he was the big shot, he was the big kahuna. He got demoted. He had to step down. And when they say step down, that's politely, they put it out there. They don't say he was fired or he was demoted. They allow it to be stated as he stepped down to try to make people think like, oh, maybe it was his decision. I'm telling you right now, it wasn't his decision. Okay, he got demoted. And so I was like, finally, right? I mean, you never see this happen. This is the cool part about it, is that as much as I rant and rave about how these guys all get it wrong and all lack fundamental understanding. You never see them get chopped. You never see them get the axe. This guy got the axe. Maybe he's not fired, but he got the axe from his high position. And now I find out yesterday that this guy I think he's at Bank of America, this guy Marco Kolanic or Kolvanik or something, I don't know his name. That the trading desk, the traders at Bank of America, they can't stand this guy, and it was put out publicly like they're not paying any attention to anything he says anymore, and they're saying we got to buy the market. He's been so wrong the whole entire time. The irony is now, what if the market does fall, and all these dummies on the trading desk who were following this guy Kolavanik or whatever the fuck his name is, who were following him the whole time, and now they're jumping in. Now they're saying, oh, now it's okay to be bullish. Like, I'm just sitting here and I'm like, where do they get these people? Like, where do they get these people? It's wild, man. It really is wild. So there's something else I want to touch on today, and that is we're also seeing recently, like I've been talking about the de-dollarization for a long time, and I've said, like, it's not what people think, okay? People think that de-dollarization, this trend, which was really put in motion, I think, when we saw the massive sanctions on Russia for the invasion of Ukraine, and sanctions everywhere, the United States using the dollar as a weapon, and in a sense weaponizing the US dollar, shutting entire countries, shutting down SWIFT payments, shutting entire countries out of the dollar-based global financial system. I said this was going to trigger a reaction. Don't think that these entities and these financial institutions and these nations were going to sit by without trying to come up with a way around these sanctions or new trading arrangements. So anyway, this was all within this idea of de-dollarization. But I said that this was not going to be necessarily bearish for the dollar, but you still see a lot of people thinking like, oh, if the world wants to get rid of their dollars, the dollar's going to get crushed. I just saw another headline today from a guy. He's kind of like ancient on Wall Street. This guy, Dick Beauvais, he's a bank analyst. I've not followed him, but I've seen his name and I've watched him over the years that I've been involved, which is like more than 40 years, me, okay? 40 going on 45 years in the Wall Street financial trader, whatever you want to say. But this quote today from this relic, Dick Beauvais, and it's funny that these guys still get attention and they still get media. Like, really, you're scraping the bottom of the barrel. I'm sorry. But like he's like saying the Chinese yuan is going to become the next global reserve currency, and that portends like really bad things for the US dollar. And you have to understand something. First of all, it doesn't. And second of all, it may actually be the opposite of what he's saying. In other words, that the Chinese currency long term, if indeed the world now is shifting to the Chinese currency, which it's doubtful, but let's just say that's a nascent trend, a beginning trend, very slow, just starting to take off. That has implications for the Chinese currency. But the implications for the dollar, the assumption that the dollar is going to crash, it's going to go down, is completely wrong, and I'm going to tell you why. First of all, you have to understand that if country A sells their dollars to country B because they don't want to hold dollars anymore, like Russia got rid of all of its dollars, it sold it off to who? Maybe to some European nations, maybe to South America, maybe to Brazil, I don't know. But if country A sells its dollars to country B, those dollars still exist in the global financial system. They're still out there. They've just changed hands. That's just a bookkeeping entry. Country A gives their dollars to country B. You might have a short-term negative effect if the selling is, of a certain magnitude. But the foreign exchange market is so huge that it would take a really big number in a very short period of time to have even a small effect on exchange rates. So really that's not going to be an issue. But the point I'm making is that de-dollarization is not about some country selling its dollars to some other country. That doesn't reduce the global supply of dollars in the system, in the global system. There's only one way for the rest of the world to rid itself of dollars, and that is by exchanging those dollars for goods, services, and assets in the United States, right? It's kind of like, how do you extinguish a loan? You pay it back, all right? How do you get rid of those dollars? You send it back to its source, which is where it comes from, which is the sovereign, the United States, the issuer. So that is not in and of itself a bearish thing, because first of all, it reduces the global supply of dollars in the system globally, okay? It just sends them back, those foreign dollar accounts are extinguished, okay? And secondly, what happens is there's only one way that the world can exchange its dollars for goods, services, and assets in the United States, is they have to buy goods, services, and assets produced in America. So what does that do? And we're starting to see some of this now in the exports of petroleum and petroleum products by the United States. The United States is a net exporter of oil and petroleum products. So we're starting to see this, and the trade deficit is starting to shrink. It's still pretty big, but it's nowhere near where it was at previous times. I mean, now it's about 700 billion. It was probably closer to $1 trillion or more around the COVID time. So that's how it goes. This exchange for goods, services, and assets produced in the United States shrinks the global supply of dollars outside. Outside. There's really no dollars outside. They all reside at the Fed. But I'm just saying, the bookkeeping, right? The foreign holdings go down. But there's still a demand for dollars because they need to get rid of them. These other entities, the rest of the world, needs to exchange those dollars for goods, services, and assets in the United States. So what happens is that the U.S. trade deficit shrinks. The global supply of dollars in the system shrinks. That's not a bearish thing. Okay? Now, conversely, if indeed the rest of the world, or the world, decides to net save in Chinese yuan, there's only one way they can do that. And it's the same way that the world saves in dollars. They have to sell stuff. You got to sell stuff to China. That's the only way to get that currency. So that would mean over time that the Chinese trade surplus, current account surplus, would flip into a deficit. And it would also mean that if the world wants to hold and net save in Chinese currency, that necessarily creates more currency. Now, I don't know if the Chinese government would try to fight this. I suspect that at least initially now they would try to fight this. But I mean, the global economy is too big that ultimately they would lose that fight, and that the paradigm would shift. And it would not be, that doesn't mean it could cause a crash in the Chinese currency, but it would be like the same kind of long-term behavior of the dollar. You know, there's times when the dollar's up, there's times when the dollar's down. In general, since the United States has been the reserve currency, if you go back to 1971, I mean, the dollar is basically, with the exception of if you compare it to like emerging market currencies, if you compare it to big economies, the dollar is down since 1971. So that it would be the same kind of pattern for the Chinese. But all this hoopla, all this, oh, it's gonna be the end of the dollar, and you know, that's all nonsense, man. Again, it's just like it's just emotional, hysterical nonsense of people who don't understand. And they just think in their heads, oh, this is going to be some kind of apocalyptic event. If this happens, it's like the end of the world, the end of the universe. It's not. It's just not. I mean, this is where you have to be savvy and informed and just cool it, man. Just like stay cool, stay control of your emotions, go about this in a scientific way. Don't get all like, oh, this is gonna happen, it's gonna be apocalyptic. Like, really, these people, I just sit back and I'm like, wow, what are they talking about? I mean, you've been around. This guy Beauvais has been around he's gotta be, I'm sure he's around longer than me. He's gotta have been around in the markets in Wall Street for like 50 years. I mean, if I'm doing 45 right now, you better believe it. But like, don't they think? It's a question I ask, maybe, you know, rhetorically almost every time I make a video. But like, really, don't they think? I don't know. I really can't tell you. Anyway, that's it for today, folks. It's been raining like crazy out here in Southern California. I mean, you've probably been reading about it. That's been like apocalyptic almost. Mudslides, rock slides, hills coming down, flooding everywhere. And yeah, it's really been something else, man. So, but it's about to end and we'll get back to our sunny weather. Anyway, that's it for today. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.